Good morning and good afternoon, and welcome to The Point, where David Balin and Stephen Whiting are going to speak about a very serious topic, the fact that the U.S. is squandering economic and market leadership. Now, why would we say something like that when the market is doing well and when, as Stephen will tell you, the economy is too? There's a lot of things going on that are contradictory. We'll be talking about military action. We'll be talking a little bit about what's happening in the actual government in terms of a potential shutdown. Stephen will cover all of that. But the bottom line is that a lot of the discord that's being talked about, right, and she created is actually political and geopolitical. And that is not having much to do with the economy, but it might. And that's what we're going to spend some time talking about today. So, Stephen, let's take a look at some of the news that we've actually seen this week about the government shutdown, about Powell's charges, right, and especially about the fact that when Trump went to Davos, the residual impact has been an enormous sense that the world has to actually continue to sort of disaggregate and to reform different coalitions. And how will that, in your mind, ultimately impact markets relative to where they are today?
Diversification from US dollar assets is taking place. You can see it in the drop in the US dollar. Last week it was 1.9%. This week it's continued again. And that's difficult when you consider how much positioning and worry there was about the independence of the Fed. Of course, we've covered the news. Fed Chairman Powell being investigated for a criminal offense, was over his testimony about construction for the Fed, these sorts of things. He said that it's about trying to manipulate Fed policy, which is very clearly the wrong thing for the US dollar. But all of this news, again, had all of this short positioning and betting against the dollar, really long positions in gold, and yet here we are, gold in fact today over $5,500 an ounce. If anybody ever got a silver dollar from their grandfather, if you ever remember those things that were in circulation, they were $1 face value and they were used for money 100 years ago, 120 bucks today for one of those coins, right? So it's a very strange time. We'll try to put this in perspective with some of the economic charts because a good deal of this is bullish for financial markets, and yet we face all this turmoil, the potential for military action in Iran, which can spike the oil price. We can talk about that. And then we don't know, is there going to be a government shutdown with all that's taking place in the very short run over the situation with immigration?
Right. And that's really, the key message, right, is that what we're seeing is that all of this domestic and international policy news, right, is actually crowding out the essential good performance of the economy, relatively good performance of corporate earnings, which we'll talk about. And that's really, what we have to, sort of steady ourselves and right, make sure we position portfolios right. So let's move ahead in the presentation and talk about this, right? Now, we've been talking really since probably 5 months ago about the fact that the U.S. and the world economy are strengthening, right? But that the weakness, if you will, is the fact that policy has become more and more and more erratic. And some of these, are old pieces of data, right? Some of the loan standards, right, you've talked about, and the easing that is allowing banks to lend more. But the more recent data that I'd love you to talk about, Stephen, is the fact that we're seeing mortgage purchase applications rise pretty substantially. And what does that mean for the economy overall?
So that picture on the left, for example, shows that the housing market has been weak, right? We had a lot of rate shock from the great inflation that we saw in 2021. The Federal Reserve tightened in 2022. Mortgage rates went well above 6%. And so housing turnover just died in the United States. Now, there's been a little rise in construction for a while, but last year, if you think about how strong the economy was, in fact, for 3 consecutive quarters now, we think GDP was over 4%, but residential construction fell about 2 to 3% in real terms. Now, what that is showing, this 19% rise that we've seen year to year in mortgage applications is a reflection of what you see on the right. Easing lending standards by banks. Mortgage spreads are coming down. The long-term treasury yield is in the ballpark of steady, but what we're seeing again is finally, money really start to get more active in lending. Now, why would we be concerned about this? Well, President Trump has suggested a 10% cap on credit card rates. Now, look, that's only one category of lending. It's not going to wreck the economy. But when we're talking about market interference, We have credit cards. There are some people who will default. It's an unsecured loan. If you can't differentiate what the rate will be, that's a problem for banks that were counting on deregulation. It's why we had powerful performance for banks and equities last year.
Exactly. So that's a kind of policy dysmorphia, right? We're talking about it, and the fact is that he can't just change the rates himself. But again, that's not something that we've actually seen. Of the things he can do. Now,
let me try to relate these two charts, David.
Yeah, please go right ahead.
So if you see an up arrow on the left and a down arrow on the right, and you can see a drop and a spike around that area, these are related. On the left, we have this big drop and surge around the pandemic and industrial production in the United States and around the world. But that weakening that we had was very much about business caution. When you read the Institute for Supply Management's monthly report and you read the industry comments, through most of last year, 8 out of 10 or 9 out of 10 U.S. manufacturing industries said tariff uncertainty and the cost of inputs, so American producers trying to get copper from Chile, for example, right, to make integrated circuits, that sort of thing was holding down American production. We've had nothing but declines in the manufacturing sector and employment. Again, it's a secular decline industry, but those job losses accelerated over the course of last year. And the culprit was the picture on the right, trade policy uncertainty. Now, we raised U.S. tariffs by $185 billion over the course of last year, but that's 0.6% of U.S. GDP. That's not that critical. Uncertainty about your cost of business, whether you want to be producing, is a really costly thing for the economy. Now you can see we went dormant for a while. We stopped having trade wars. We stopped with new tariff threats. Now that data on the right, the Trade Policy Uncertainty Index, doesn't reflect the fact that President Trump threatened new tariffs against the EU, withdrew them. Again, now he's threatened tariffs on Canada. We'll see where that goes. Tariffs on South Korea. And by the way, this is in the Supreme Court as to whether or not universal tariffs are possible when they should be directed, again, in the Constitution by the Congress.
Right. And of course, with the dollar having declined so much, Stephen, that obviously does impact the input costs for manufacturers who are importing goods in order to make finished goods. So look,
but that on the left shows that we were poised for recovery, right? In construction, in trade, in manufacturing. And if you look at the next page, maybe David, if you want to take this on AI CapEx.
Right. So AI CapEx, continues to grow. At the very end of last year, as we pointed out before, the stated amounts of AI CapEx growth were actually put up. But what we've actually seen in the announcements of the early earnings announcements by Microsoft and Meta is there is going to be, I think, a reckoning here where spending, even though it's going up, will have to be justified by increased earnings. Zuckerberg, right, came out and basically made extraordinarily bullish bets in terms of how much he was going to spend of his cash flow on continued build out. Stock rallied as a result, right? Microsoft, which actually had a pretty extraordinary earnings, actually fell on the news, right, that there were concerns about whether it could sustain the growth rate and revenues associated with its AI businesses. But the bottom line is that the build out, right, is well underway, and it is ahead of the actual demand and utilization for AI. So what we're seeing is that data center spending is in fact, powering the economy. It's over, as Stephen has pointed out, at sort of 10x the GDP rate. It's unsustainable, but it is what is carrying the market at this point in time. So with that as the backdrop, right, and with the fact that the overall economy is doing better this year, we've seen this market, continue to rise. But we've also seen the dollar falling, and as Stephen's mentioned, gold and silver doing extraordinarily well, which represent hedges on it, and now I think largely speculative activity in the market. So we'll talk more about that. Let's move on to the next slide.
So let's just talk a little bit about inflation dynamics. Chairman Powell and the Fed, after 3 consecutive rate cuts, took a pause. We have this history of early year inflation data, despite seasonal adjustment, having these discrete one-time price adjustments. So the chance of a hot CPI or PCE report for inflation in January is there. The Federal Reserve, again, is sitting on the sidelines a little bit. Some argue that Powell won't ease again, that a new chairman will. We'll see about that. We think that, again, what we've seen out of the labor market has been really crawling, slow employment growth. That has something to do with what David just talked about. This powerful AI spending is getting us around 4% GDP growth, but consumers are actually contributing as well. Now, if you take a look at that right picture, you can see these various measures of consumer confidence have all been very weak. Yet the run rate of consumer spending that we have here in the fourth quarter in inflation-adjusted terms is 3.5%. The biggest component of GDP is growing 3.5% despite weak confidence. Now,
Right, and I think that's where the data, right? When you look at these charts and their headlines, right? They're actually not representative of what's actually happening. I think that in some ways, and we've talked about this, that the consumer sentiment data is not really what we need to track. We have to actually track real spending on an inflation-adjusted basis.
There's still news flow that's happening. We're going to be concerned. We can talk about Iran. I do think that oil can jump to about $75 pretty quickly if there are disruptions in production related to Iran. This is highly speculative to talk about. Again, the greater security of that region is very much dependent on the Straits of Hormuz, these sorts of things. These things can result in temporary oil spikes. One of the things that's been helping us is what you see on the left is that inflation expectations. Really interesting reading because I'm showing you the 5-year median inflation expectation in the same consumer confidence surveys. Now, the 1 years jumped a lot around the pandemic. People believed that they had anchored inflation expectations. They said, okay, this pandemic will end, the government will get this right, there won't be shortages, and inflation's not going to rise that much 5 years from now. You go to where we were last year with the trade wars resuming, and pretty strangely, we started to see the highest inflation expectations over the longer term. People experience that short-term rise in inflation. They start to get really sensitive to any news that tariffs would push up inflation over the long run. But that's been coming down. So again, the sensitivity here is we've been on an improving path and we could actually spoil this with policy uncertainty. Now, again, that's not going to be our base case view. We've seen lots of reactions out of the administration on all sorts of issues. Tariff threats come and then they go. But importantly, this is still affecting, again, markets and the economy in a way that we'll talk about in a little bit has been adverse for U.S. assets compared to the rest of the world, which are just getting flattered by comparison.
That's right. And we've seen that in our portfolios and our portfolio results, Stephen, as we ended 2025. So let's move ahead. As Stephen was talking about, right, assets, reflect, asset markets reflect fundamentals over time. And the same thing is true of poor policy, right? And so we're seeing record high U.S. profits, right? But we're also seeing, some troubling signs when it comes to employment. Stephen's talked about it in manufacturing. We saw Amazon actually announce 16,000 additional job cuts. They seem to be doing that, Stephen, right at the same time they're, announcing earnings, right? But we think that AI is going to help maintain record high profits, in part because of the efficiencies it derives, but also, in fact, because of the fact that labor demand actually will go down, and obviously pressure on the cost of labor will also go down. So we see this happening in markets, Stephen. Do you think that GDP growth, can be supported, right, by AI and by higher efficiency levels and higher productivity?
I think so. Look, this doesn't last forever. Over time, again, we adjust the capital stock. It's really, look, a positive thing when labor and physical capital and intellectual capital come together. You produce more. And as you get more capital and less labor over time, capital returns come down some. Again, we'll have robots competing against robots, eventually pushing down profits. But in the initial phase of all of this, this can be a windfall of profits for capital. And that's what we seem to be, I still think, at the fairly early stages on.
That's right. All right, so let's move ahead.
So let's emphasize on this one that we're going to talk a little bit now about asset price performance. And what you can see, we've been showing a picture of last year for a while now, where last year non-U.S. equities outperformed U.S. by 16.5% in dollar terms, and about half that in local terms. And it's a new year. We have less than a month of data, but we're seeing the same pattern again, where most non-U.S. markets are at least slightly, or in some cases significantly outperforming in local terms and outperforming in US dollar terms. And what the picture on the right shows is, I think, a purer measure, again, of risk aversion about US assets. Maybe it's the strong economy, but the reality is we are seeing US bond spreads pick up against safe haven markets like the Swiss franc, the same behavior we're seeing in the exchange rate.
That's right. And again, that's one of the reasons why, investors at CIO Group have been getting more exposure, right, to our international securities. When we take a look at one of the reasons why our, 62% equity, 38% debt portfolio hit almost a return of the S&P, it was because of two things. One is the bond selections that we had in our portfolio, but the larger contributor was our international exposure, predominantly actually in Asia. This year, I think we're going to see an additional increase in performance associated with Latin America, sort of a catch-up trade. But the bottom line is that U.S. investors who are not exposed to international markets don't have the benefit of the double pickup that Stephen talked about, which is both local performance of shares as well as the decline in the dollar, causing a total return, as you can see on the left, that's materially higher. Next slide. So that's something we've done in portfolio, but the news of the week, right, turned out to be, right, so far, and by the way, the week is only like 60% over, right, is sort of gold and silver. And it would be useful to talk about, Stephen, whether this is now speculation well beyond a hedge. But what I really wanted to talk about today was the fact that, when you look at silver prices relative to gold, we look like we're in that sort of hysterical bubble period when the market was trying to be cornered by a couple of brothers, the Hunt brothers, as I recall.
Yeah, so we're going to talk about these for a bit, and these charts here can't even keep up with the price action. We put log charts here so you can see some of the numbers on this, and we'll go through all of it. But these are really remarkable increases in these prices, and the price of gold now over $5,500 this morning. What we can see is that the increase in the last year or so is the largest since we broke a peg in gold. There was a price control period for gold. Again, in the early 70s that came off and it crawled for a while. But we saw a massive surge during the great inflation of the 1970s, where 10% inflation for the whole sustained decade and 10% money growth. We saw massive increases in the gold price then. So we're in a period that's acting like that now. And the reality is inflation isn't rising that much. So some concern level, diversification, again, out of US dollar assets seems to be part of this. We can't track central bank purchases of gold right in real time, but we've seen a lot. But I think that there's now a period where investor speculation is just going all out, and the chance that we're going to have a decline is going to be a significant scale. Now, if you think about the largest one-year decline in gold that we have seen, it's about 41%. The largest decline in silver is over 60%. The largest decline that we've had in silver over a long period of time has been about 92%. We're talking about a volatile asset here. The bottom line is that gold and silver have these discrete jumps. Then they tend to go dormant for a long time. And that's one of the problems when you're using this and you're getting in late. We've used gold as a hedge in portfolios. We've cut back the absolute size some. Now, I want to show you what David just mentioned on the next page. So if you take a look, when silver is rising much more rapidly than gold, well, what happens is the gold-silver ratio goes down, right? This is an easy way to look at it. Silver's outperforming gold. It's going through the roof, and it's changing much more rapidly than anything in the economy. We use silver for some industrial technology functions, but the price is increasing much, much more than that. Now, if you look at that period around 1980, David mentioned the Hunt brothers. Well, you take a look at what was one of the things that signaled that the rally was near a very speculative frothy end. It's when the gold-silver price ratio plunges like this, and silver's worth so much compared to gold, and that's what's happened now. So where are we? We can't exactly tell what people will do next. They could still fear missing out and jump right in, but the chance that we're actually building in a lot of risk in precious metals now is pretty significant. Even as I think that, again, the news environment we just talked about is very fundamentally bullish for precious metals.
That's right. And again, this looks to us, and this is certainly true of a lot of the industrial metals as well, as pretty extraordinary. So our point of all of this, right? If we had to leave with, one major point is that, and we've been building on this point now for basically since we started the company, is that this diversification that we talk about, the need for diversification, has only grown because the risks are centered here. Even though the US is the largest market by far and that US assets dominate, right, portfolios, diversification, right, has two benefits. One is actually is risk reducing, but in the case, I think, of market conditions that Stephen has described, it's actually return enhancing. Now, why is that? We've talked about the fact that earnings growth in the United States is going up. We've also emphasized the fact that earnings worldwide are going up. And we've seen that take place in several areas, but in particular, right, in Asian markets, with the recovery in particular of technology shares and AI related activity. That is going to continue. We've seen more investment, right, in Europe in its own defense industries and actually an inward focus, right, in seeing growth in its own economy because of the trade situation with the United States. All of this, right, that suggests that there's going to be a change in leadership, not necessarily leadership in total market value, but leadership potentially in markets. And you can see that on the right, when we think about, right, the US as a large share of world equity markets, that's not going to change. But the fact that it's going to be as high as it was for as long as it was can change. And that actually is, I think, where we are right now, Stephen, at a place where, the leadership, the fact that we're the largest percentage, will remain. But the question is by what amount?
Right. And the picture on the right just shows that they've had really well-defined cycles here in the dollar and U.S. equity outperformance. And again, we've been expecting a 10% return in U.S. equities this year. I, in some ways, biased below the very bullish consensus that you see from Wall Street strategists. And the reason for this is a lot of this policy uncertainty. It's possible, again, that if that uncertainty went dormant, the economy would have a great year. We'd see even stronger returns. We have to consider that American tech firms and our ability to commercialize AI is a real strength. But when you've had this period prior to 2025, 15 consecutive years of outperformance, significantly higher valuations in US companies, this is one of the reasons why we've added some diversification. You can take a look at the next page. We've already moved up to 21% on non-US equities in balanced portfolios. Again, portfolios that have, a little bit short of 40% in fixed income. It still is, the largest weighting is still US. Thematically, we still have our weights mostly focused on US industries, but we've gotten exposure again to the highest yielding equities and certainly some emerging growth technology in Asia, for example. And that's the broader Asia region of South Korea, Taiwan, China, etc. So these are areas, again, that we think have strong returns that are not just diversification, but are actually good opportunities for returns this year.
Right. And you'll also notice that we have a bias, right, toward larger companies in general, both in the US and non-US, reflecting, I think, the fact that in a deregulatory environment with the earnings that we've seen, that trend will actually continue as well. So with all of this uncertainty, the critical messages for us are obviously that we are paying attention to the fundamentals. As Stephen said at the outset of today's call, with GDP growth at 4% for the last 3 quarters, that news is being overshadowed by everything else that we talked about today. But that is what's driving the market. When you're hearing headlines about the consumer not really doing well, that's exactly not true when it comes to how they're actually spending. When we look at the broadening of the economy, we saw new data that showed that mortgage applications were going up and that the easing credit standards were going to allow a broadening, right, of construction spending in residential and in commercial areas. And all of this obviously taking place at a time when AI spending for 2026 looks particularly strong. And that's why we titled this that the US is squandering economic and market leadership, not so much because the news about the economy is bad, because actually it's quite strong, but the fact is that all of these policy uncertainties, whether it comes from tariffs, military action, government shutdowns, right, all of this has caused a fundamental shift in the way investors are positioned in US versus non-US assets and in seeking hedges, right, away from the US dollar. So a lot of you who've got portfolios here with CIO Group have benefited from the fact that we have followed our trends and followed the facts rather than the news, which is great. But we are mindful of the fact that some of these circumstances, right, can ultimately have deep impacts on not only the economy, but also on how investors are going to place money into markets. So, Stephen, thank you very much for the time today. It's always a pleasure to talk with you. You notice, by the way, for those of you looking, that there's a new big red dot. I don't know what that means, but it is very exciting to have the dot, and so we look forward to seeing you next week on The Point, and hope that you'll read our other Point bulletin, which will be coming out over the course of the weekend.
Thank you, David. These are all sensitive subjects. We want to be as fair and unbiased as we possibly can on analyzing this. I think the data has been very clear that there are costs to uncertainty in the economy. Thank you.